Hey guys, welcome back to week number 5 of Did You Know? All Things Insurance. And Chris Hundley is back with us this week, and we're going to go over another aspect of homeowners insurance. We're breaking it down week by week so you can kind of get bite-sized pieces and really get an understanding. And if you have any questions, you can reach out to me or Chris. We'll give you the information in the comments above and below just so you have a resource for that. Chris, welcome back. Thanks for being back this week.
I appreciate you. Thanks for having me again.
Yeah. Well, hey, this week, I would like you to break down the mortgage requirement for insurance. I think everybody knows it's required, or maybe they don't know it's required. But yeah, break that down for us a little bit if you would.
Yep. So the big thing is we have a lot of mortgage companies, just like we have a lot of insurance companies, and each one is kind of different. So I'm not going to sit here and act like I know every single mortgage company out there and their requirements for each, but we're going to kind of touch on the big ones. So the big one is, at least in the state of Florida, if you have a mortgage, you are required to have insurance. Now, what is required to be on that insurance? Number one is the coverage A, and that is the actual coverage for the house. With that, there's two kind of big things with it. One is the replacement cost coverage, meaning in the event that it was a total loss, would the loan amount be completely covered? So either you need the replacement cost or you need that coverage to be above the loan amount. And where this comes into play is, let's say you have bought $1 million property, and it factors in land, how close you are to the beach, what school district you're in, but the actual home on that property is only worth $800,000. My job is to insure the property, not the land. So I can come in there, write an $800,000 coverage A, but put replacement cost on it, so that way the actual house is covered. So the big thing is replacement cost or the loan amount is actually met. The next is hurricane coverage or wind hail. So some companies kind of include it into all of the perils or hurricane, but they want to see that there is replacement cost coverage as well as wind hail coverage. And then after that, they really don't care about personal property. Depending on the type of loan that you get, if you're an investor and it's an investment property, some companies will want loss of use coverage. But the biggest thing is, if you are working with a mortgage lender, mortgage broker, get them in touch with the insurance agent early. And that way they can see all the requirements for the type of loan that you're getting, whether it be a FHA, conventional, VA, DSCR, whatever it is, there's going to be different requirements for us. So we need to make sure that we're hitting all those wickets for them. So lots of information.
Yeah.
Again, bringing a mortgage company in, everybody has different things that they work, just like insurance carriers. So those are the big kind of wickets.
Gotcha. So communication is key. Early communication is
100%. Yes, sir.
Awesome. Well, thank you, Chris. And now you know.